Hello and welcome on board FM Mock Debrief. I'm Rashad Hussain, your expert tutor for FM. Today, we'll be looking at Section C, Luminex Corporation, which is a 20-mark question and has three requirements. It covers the topic of working capital, dividend policy, source of finance. Let's have a look into it. Here with requirement A of Luminex Corporation, evaluate if Brightpath proposal is financially acceptable to Luminex Corporation. What is this Brightpath here? We will get it here from the question. Considering a proposal from a factoring company, Brightpath offered to manage its sales ledger on a with recourse basis. Let's have a look to understand what is with this recourse basis. What is the recourse basis? And meanwhile, I'll request you to pause the video, go through the question, and try solving the question before watching the rest of the video. Moving to understand the concept of recourse basis. As far as factoring is concerned, there are two types of factoring. One, which is the non recourse factoring. Wherever the question is silent, it is generally the non recourse factoring. And the other one is with recourse factoring. So wherever the question is silent, it is non-recourse factoring. And what does non-recourse factoring means? Non-recourse factoring is where the factor bears the bad debt. This is where factor bears the bad debt or the irrecoverable debt. But whereas with recourse factoring, the factor does not bear the bad debt. Factor collects the bad debt from the company. So here the factor does not bear the bad debt. Does not bear the bad debt. Now in the first one, the non-recourse factoring, when the factor bears the bad debt, what is it? From the company perspective, company is insured, company does not bear the bad debt, company does not have to be worried about the bad debt. So which means the company is insured and does not have to be worried about, does not have to be worried of bad debt. But whereas in the case of with recourse factoring, what happens? The company bears a bad debt. Company, the factor does not, and the company bears the bad debt. And here, this question here, the question called Luminex Corporation, which one is it? Is it non-recourse or with recourse? Yes, it is with recourse factoring. So this is how the Luminex Corporation is. So this is something that we need to understand first. And based on this, we need to calculate what is the cost when Luminex does itself in-house accounts receivable management, and what is the cost when Luminex is going to assign it to a factor. So now let's look at calculating the cost of in-house versus the calculating the cost of the service that is rendered by the factor. Calculating the in-house receivable management cost. Putting two columns, the particulars and an amount in dollar, a large particulars column. And from the question, we'll understand that we are looking for two costs. In-house will have three costs to be specific, that it'll have short term finance interest on the average receivables. It will have existing irrecoverable debts and also administrative cost. And all of these, when I total, I will get total cost of in-house management. This is going to give me the total cost of in-house management versus which I need to compare the factoring service. Again, for this particulars column and an amount in dollar. What are the costs that are relevant over here? One, this is also going to have the factor is giving us an advance, so there is going to be a factor finance cost which is going to be on the average accounts receivable, and then we're also going to have short term home interest, short term finance, short term finance interest on the balance average accounts receivable. We are going to have a factor fee and also irrecoverable debts. And from this, we will find out the total cost of factoring. Now, as we read the question, using tool to wrap the text from format, go to cells, select alignment, and in the alignment, select wrap text, click OK. Now what happens? The text gets wrapped in the cell. Now let's go through the question in order to fill this up. The first point, Luminex Corporation generates revenue from credit sales amounting to 36 million. This is the annual credit sales. We will require this in a couple of places. So let's have all fill all those places where we will require this 36 million. So these are the couple of places where we'll require this 36 million. Despite requiring all customers to settle the invoices within 30 days, customers often take longer. Roughly 0.5% of credit sales result in irrecoverable debts that remain outstanding and unrecovered. So here, how much percentage? Which is 0.5 percentage is the irrecoverable bad debts. Trade receivables are currently 5 million, which means the short-term finance is going to be calculated at what is it? 5 million, not on 30. The average is already given. We do not have to find out the average. On this, it is written the Luminex Corporation incurs a short-term finance of what percentage? 8%. That 8% is calculated. Considering a proposal from the factoring company Brightpath offered to manage its sales ledger with recourse basis, which is the reason we've got what is it? Existing irrecoverable bad debts here and irrecoverable bad debts. Why the company has to bear the bad debts on a with recourse basis. Here, both of these in-house, what is the cost for the company? When we assign it to the factor, what is the cost that the company has to bear when we appoint a factor? That is the perspective here. So Brightpath aims to leverage its expertise to reduce average trade receivables to 20 days. So here it is going to be divided by 360 has written at the end of the question, 360 into 20 days. 360 into 20 days. Now, while cutting bad debts by what is it, 80 percentage, that means compared to the previous bad debts, our bad debts is not going to be now 80%. 80% is cut. It is going to be 20% of the previous. It's going to be 20% of the previous. Lowering administration cost by 120,000. Administration cost is only going to be there when we do in-house. That administration cost is considered. As a part of the factoring arrangement, Brightpath would advance 70% of the invoice. So here it is going to be on this figure. The factor is going to advance 70%. So 70% is going to be on the factor finance, and the balance 30% is going to be on the short-term finance. The company will have to arrange itself on the short-term finance. Now, how much is the factor going to charge? Factor is going to charge 9%. Factor is on that average, factor is going to charge 9%. On short-term finance, as already specified above, it is going to be 8%. It's going to be 8%. Brightpath would levy an annual fee. The fee of factoring, how much is it? 1.25% of the credit sales. So this figure into 1.25 percentage. Now, how much do we have? The cost of in-house, when we do it in-house, it is 700,000, and the cost when we do it with the help of a factor, it is 660,000, which means we are going to save. So the savings on opting for factoring, how much is the savings? The difference between 700,000 minus 660, there is a 40,000 saving on factoring. Our comment is going to be what? Yes, it is financially acceptable to Luminex company. There is a net benefit, there is no cost. The factor arrangement is therefore financially acceptable. So let's have the comment here. The factors offer is will be financially acceptable to Luminex company, as it reduces cost and there is savings. The factor offer is therefore financially acceptable. This is how our comment is supposed to be as far as requirement A is concerned. Now, moving on to the next requirement. Requirement B is to B and C is there together. B, discuss the factors to be considered in shaping the dividend policy of a publicly listed company on the stock exchange. So, a company that is going to pay dividend, what are the things that it needs to take care? What are the things that it needs to ensure before paying dividend as far as a publicly listed company is concerned? And the C requirement is about explain any two explain any two Islamic financial instruments available to the business, which is part of the topic source of finance. Going into the B requirement, discussing the B and having its point on the screen. The requirement B about factors to be considered while shaping the dividend policy. A couple of things to be taken care is that one, the company has to be profitable, and it is supposed to be paid out of, as per the company, as per the law of distributable profit, as per the company law, it is supposed to be paid out of accumulated net realized profit only, and not just profit. The company should have sufficient liquidity to meet this, sufficient liquidity to pay dividends. Before paying dividends, the company has to ensure whether it has any covenants to comply with. Certain times when you take loan, there might be restrictions in paying dividend before closure of the loan, or they might be sometimes government restriction in paying dividend. Before paying dividend, we need to take care of the gearing level of the company. If the gearing is very high, it would be better not to pay dividend or resort to lower dividends, because What happens when the gearing is very high? Low dividend payout can, can help us to keep retained earnings, which will then reduce the level of gearing as we have higher level of reserves. And another thing to be covered, concerned, is that certain companies do not have access to all the sources of finance. They might not be able to raise fund. So the availability of sources of finance, whether they can get another fund or they will have to still rely on the retained earnings as a source of finance. And finally, the most important thing is to take care about the signaling effects. What is the impact? More dividend, it would increase share price. Lesser dividend, reducing the share price. So, dividend policy serves as a signal to the investors about the strength of the underlying cash flow. So we need to design the dividend policy in such that it gives a positive news about the company. It sends positive signal to the market, whereby the company is able to maintain a good share price. So here the final point will be the signaling effect. Now drafting this into proper suggested answer being loaded on the screen. Now, what has been explained is loaded here as proper answer. You can pause and go through it. All the points: liquidity, gearing, accessibility to alternative sources of finance, and signaling effect. So, whatever is explained is now there on the screen in proper exam form. Now, looking into the next one, which is the C requirement. As far as Islamic finance is concerned, our syllabus deals with a couple of models. Here we've got to explain any two Islamic financial instruments, and which is for 6 marks. Basically, Islamic financial instruments are against a very important thing. And what is that important thing that it is against? It is against riba. What is riba? Riba is interest. Interest is money making money, which is considered to be immoral as per the law that the Islamic finance follows, and that law is called as the Sharia law. As per the Sharia law, it is not correct to collect interest, that is riba. So the key principle is that charging interest, making money from money, is forbidden under the Sharia law, the law that is based on which the Islamic finance is built up. So the money that we generate is supposed to should not be just getting rewards, but also we should be sharing the risk that is associated from it. So two Islamic finance instruments that we are discussing here are as follows. 1, 2, 3, start. Well, the first model of Islamic finance that we are discussing here is the Mudarraba. In Mudarraba, suppose let's assume this one is the business. There are two parties to the business. One party is only going to put expertise, and the other party is only going to put money. So there are two parties to this business, where one is going to put money and the other one is going to put expertise. So here the capital contribution is by one party and the other party is only going to put the expertise. And the profit that comes out of this business is shared by these two parties. The profit is being shared by these two parties in pre-agreed ratio. The person who gives money is called as the Rabbal Mal. The person who gives money is called as the contributes the capital is called Rabbal Mal. And the other partner who does the expertise, who runs the show, is called as Mudarrib. He gives his skill and expertise. This is similar to a partnership but where there is only one partner has a right to interfere into the day-to-day operation, which is the person who gives the expertise and not the provider or the contributor of the capital. Here, the mudarrib runs the business, and the other provider, which is the Rabbal Mal, the capital contributor, has to rely on the mudarrib, his ability to manage the business, his honesty, and what happens, the profit is shared at the pre-agreed ratio. This is as far as mudarraba is concerned. Now, another model, the second model that we discuss here is called Murabbaha. Murabbaha. Murabbaha is where, let's say, suppose I want to buy a, let's say I want to buy a mobile phone and an expensive iPhone 16. And let's assume it is not available. See, I'm not able to afford it at one single payment. I am planning to go for maybe installments. If that is the case, let's say it is on the store, at the store, it is available for $1,000. The Islamic bank will buy it from the store. Suppose it is available at the store for $1,000. The Islamic bank will buy it from the store for $1,000 and will resell it to the customer, who's going to will resell it to the customer of the Islamic bank for, let's say, 1,100. So there are people who come and ask, isn't this 1,100 interest? That extra $100, isn't it interest? No, it is not interest. Why is it not interest? It is not interest because, see, if due to some reason the customer is not able to pay that extra 100, this $1,100 is supposed to be, let's say, maybe paid by 10 installments, divided by 10, each installment of $110. This $110, due to some reason, if the customer is not able to pay on time, he can request for an extension without any penalty or without any interest on interest. So this installment is not based on time, it is just a deferred payment or installment which is on the monthly, what is it, monthly installment, which is not based on time. So here the bank which is making the $100 is actually not interest, rather it is the markup. It is like, it is like a trading here. Bank is buying at a price, selling it for a higher price. So the sale of the good is immediate against future installment. The buyer has got full knowledge about what the price is, what the quality is. The buyer is also the customer, that the buyer is aware of the exact markup that he is going to pay for this convenience. And this markup that he pays is not time dependent. Now let's draft the answer, the solution for this C requirement in proper sentences. Here we have the suggested answer. C requirement. A key principle is that interest charging and making money from money lending alone is forbidden under the Sharia law. So providers of finance are more directly involved with the risk and rewards of the business they finance. Two of the Islamic instruments that are suggested here include Mudarraba. Mudarraba transaction is a partnership transaction in which only one of the partners, Rabb al Mal, contributes, the other Mudarrib contributes skill and expertise. The contributor of capital has got no right to interfere into the day-to-day operations of the business due to the fact that one of the partners is running the business and the other is solely providing capital. The investor has to rely on the mudarrib, his ability to manage the business, and his honesty when it comes to sharing of profit or losses. The second model, Murabbaha. A Murabbaha transaction is a deferred payment sale or an installment credit sale and is mostly used for purchase of goods for immediate delivery on deferred payment terms. As a part of the contract between the buyer and the seller, the price of the good, the markup, and the delivery date and the payment dates are agreed. The sale of the good is immediate against future payments. The buyer has full knowledge of the price and the quality of the goods he buys. In addition, the buyer is also aware of the exact amount of markup that the Islamic finance is going to get. He pays for the convenience of paying later. So this is as far as the Luminex Corporation is concerned. We've now looked into all the requirements A, B, C. Well, that's all for now. Wishing you all the best for your upcoming exam. This is your FM expert tutor, Rashad Hussain, signing off. Thank you.